Welcome to the Byte-Size Brief. Today we are putting Snail Inc., that is SNAL, completely under the microscope.
We definitely have a lot to unpack with this one.
Oh, absolutely. Let's get right into it because, well, what we just witnessed in mid-April 2026 is the kind of market event that leaves, everyone from Wall Street veterans to retail day traders just scratching their heads.
Right.
We are talking about a stock that was quietly hovering near all-time lows. I mean, practically left for dead, and then boom.
A massive violent spike.
Exactly. Up anywhere from 200 to 350% in a single afternoon. The trading volume hit a staggering 854 million shares.
Which is just wild.
Right. To put that in perspective for you listeners, their average daily volume is roughly 12 million.
Yeah, it is the absolute definition of a market shockwave. But we need to be very careful right out of the gate here.
How so?
Well, when you see a microcap stock experience a liquidity event where 854 million shares change hands in a matter of hours, the sheer momentum can easily blind you.
Blind you to the actual business, you mean?
Exactly. It blinds you to the underlying mechanics of the company. So the mission of our deep dive today is to strip away all of that momentum hype. We are going to objectively examine the fundamentals of SNAL.
I love it. Just the hard facts.
Right. The critical question we have to answer for you today is this. Are we looking at a legitimate turnaround story backed by real cost-cutting and a robust game development roadmap?
Oh.
Or is this just a liquidity-strapped company riding a temporary mechanics-driven short squeeze that will, eventually come crashing back down?
Yeah, that is the million-dollar question. So we're going to unpack the incredibly complex financials, dive deep into some intense, very vocal gamer drama happening right now on the forums, and ultimately figure out what this all means for you, the everyday investor looking at SNAL.
It's a lot to cover.
It is. But to understand this massive daily surge, we first have to look at the exact headlines that triggered the algorithmic and retail buying panic in the first place.
The April catalysts.
Right. Early April hit us with dual catalysts. First, Snail Inc. secured the global publishing rights for a co-op party game called Dead Party.
From the developer Radiation Blue, yes.
Exactly. And second, we saw a massive analyst upgrade from Noble Capital, predicting over an 800% upside for the stock.
Which is a huge number.
I mean, 800% upside gets anyone's attention.
Yeah.
Well, what is actually driving that number?
What's fascinating here is this specific data driving that prediction. It wasn't just blind optimism. It was tied to a very specific, tangible operational change.
Okay, lay it on me.
So on April 6th, SNAL amended its ARK licensing agreement with a company called SDE Inc.
Right, SDE Inc.
By restructuring this deal, they effectively reduced their fixed monthly licensing payments from $2.0 million down to $1.5 million.
Oh, wow. So $500,000 in savings every month.
Exactly. And that reduced rate applies all the way until the highly anticipated ARK2 game finally launches.
Okay, that's a pretty big deal.
It is. And on top of that, they narrowed a $5 million downloadable content or DLC payment structure.
Narrowed it how?
So that it only applies to certain post-October 2023 content. That significantly reduces their immediate one-time cash obligations.
Okay, let me make sure I'm getting this. So basically, it's kind of like renegotiating your mortgage to free up $500,000 in monthly cash flow, but
you still owe on the house.
Right, you still owe the debt. So does this actually save the company, or does it just buy them a few months of oxygen?
That is precisely the right question to ask. And to answer it, we have to look at their balance sheet.
Let's do it.
Saving $500,000 a month is undeniably a positive development. However, SNAL ended 2025 with only $8.6 million in unrestricted cash.
Wow. That is not a lot for a gaming company.
It's really not. To put that into context, they have a current ratio of 0.6.
Hold on, let's break that down for a second. What does a 0.6 current ratio actually mean in plain English for our listeners?
Sure. It's a measure of short-term liquidity. A current ratio below 1.0 means a company literally does not have enough liquid assets on hand to cover its liabilities that are due within the next 12 months.
Yikes.
Yeah, it's a flashing warning light for cash burn. But here is where it gets highly concerning.
More concerning than not being able to pay your bills.
Unfortunately, yes. There is a major corporate governance risk here that investors absolutely must scrutinize.
Okay.
That licensing counterparty we just mentioned, SDE Inc.
The one they renegotiated the deal with.
Right. SDE Inc. and an outsourced developer they just signed a $1.9 million agreement with called Snail are both linked to insiders.
Wait, what?
The SDE counterparty is actually controlled by a director linked to the CEO's family.
Wait, hold on. Are you saying the CEO's family essentially controls the company's biggest debt obligations?
Yes.
How is that even legal?
It is legal as long as it is fully disclosed in SEC filings as a related party transaction.
Okay, but still.
But from an investment standpoint, it raises massive red flags. While the immediate cash savings from the renegotiation are real, whenever you have related party transactions dictating your largest expenses, the risk profile elevates significantly.
I can imagine. You have to wonder who's really benefiting.
Exactly. You have to ask whether the terms of these massive million-dollar deals are truly being negotiated at arm's length to benefit the public shareholders of SNAL, or
If they're functioning as a mechanism to shift capital from the public entity into private family-controlled hands.
precisely.
Wow. That is a crucial detail for anyone looking at SNAL right now. It fundamentally changes how you view that cost-saving headline.
It really does.
But, okay, if they just freed up that $500,000 a month in April, why was the stock so heavily shorted to begin with? I mean, was the core business actually bleeding that badly at the end of the year?
That leads us right into their financials.
Yeah, let's transition to that.
Okay.
So, compared to last quarter, what actually moved the needle here? What did the actual data look like at the end of 2025?
It was a mixed bag, to be honest. If we look at the Q4 2025 net loss, it was only $900,000.
Only $900,000. I mean, compared to what?
Compared to a brutal $7.9 million net loss in the previous quarter, Q3 of 2025.
Whoa, that is a massive sequential improvement. A $7 million swing in a single quarter is huge for a microcap. What drove that?
Well, we have to look at the revenue structure. Year over year, their net revenue was actually slightly down, landing at $25.1 million.
Down, but the loss shrank so much.
Right. Now, that slight drop in net revenue was primarily due to deferred revenue recognition.
Okay, I know this trips a lot of people up.
Yeah.
Can you explain how deferred revenue works in the gaming industry?
Absolutely. It's a common accounting quirk. When you buy a multiplayer game or a server subscription, the company doesn't get to recognize all of that money on the income statement on the day of sale.
Because they haven't earned it all yet.
Exactly. Because they have to maintain the servers and provide updates for months or even years, accounting rules force them to spread that revenue over the expected lifespan of the player.
Got it.
So net revenue doesn't always tell the whole story of a quarter's cash generation. The metric you really want to look at in the gaming sector is bookings.
Bookings.
Right. This is the actual cash crossing the register. And in Q4, SNAL's bookings surged by 22.4% to $20.8 million.
Okay, here's where it gets really interesting. Because that booking surge didn't just happen by magic.
No, it didn't.
It was driven by the launch of the ARK,
Yeah.
Lost Colony DLC, and really strong sales for ARK. Survival Ascended, or ASA.
Right, the new remaster.
Yeah. ASA has now officially crossed 4 million units sold since its launch. And total units sold across their entire portfolio in 2025 were up 32.7% to 6.3 million units.
It's a lot of units.
Plus, ARK Mobile just surpassed a massive milestone of 10 million downloads. I mean, it seems like their publisher sales events are moving major volume, and top-line engagement is just incredibly strong.
You're not wrong. The top-line user engagement is certainly the bullish pillar of the story. People are undeniably buying and downloading the games.
Right.
But here's the reality check on the bottom line. Despite those 4 million units of ASA, Q4 EBITDA was still a negative $1.3 million.
And EBITDA is basically their operational profitability, right? Earnings before interest, taxes, depreciation, and amortization.
Correct.
So they are still losing money on the actual operations. Why?
Precisely. The reason is rising operating expenses, specifically in research and development and marketing.
Ah, customer acquisition costs.
Yes, they had to spend heavily to acquire those users and get those sales. So, analytically speaking, SNAL right now is what we call cheap on sales, risky on earnings.
Let's define that for the listener. What do you mean by cheap on sales?
We look at a metric called enterprise value,
Okay.
which is basically the total price tag of the company if you were to buy all its stock and pay off all its debt, minus the cash.
Sort of the true takeover cost.
Exactly. SNAL's enterprise value is tiny relative to the tens of millions in revenue they generate.
Which looks great on paper.
Right. That discrepancy attracts momentum traders who think the stock is undervalued. But the core fundamental weakness, which is burning cash to generate those sales, proves that this recent 300% stock surge is primarily a momentum play.
It's not a fundamental shift.
No, It is not a reflection of sudden, sustainable profitability.
So basically they are selling a ton of games, but it's costing them more to make and market those games than they are actually taking in.
That's the long and short of it.
That makes perfect sense.
None of it.
And that brings us to the source of that revenue, which is the highly vocal gamer community.
Oh, yes.
Because if they are spending so much on marketing to get players, why are the actual players so furious right now?
It's quite a situation.
It really is. If you go on the Steam forums or YouTube, the drama surrounding the ARK franchise is intense. Gamers are openly accusing Snail Games of milking the IP.
Yes, that word comes up a lot.
They're saying the parent company is forcing their subsidiary, Studio Wildcard, to push out paid DLCs while the base game is still in early access. And they are absolutely livid about Snail Games shutting down official legacy servers.
The community backlash is palpable, and it extends well beyond just typical gamer gripes about game mechanics or server lag.
It's deeper than that.
Much deeper. There are specific financially driven accusations circulating rapidly. For instance, the community points to the T-Tribe scandal.
The T-Tribe?
Right. Players accuse Snail Games of mass banning players who raided a developer-supported insider tribe.
Wow, so essentially playing favorites to protect insiders in the game.
Exactly. And beyond the game itself, there are deep concerns circulating on forums regarding SEC failure to deliver, or FTD, data on the stock itself.
Wait, gamers are looking at SEC stock data?
Yes. Retail traders in the community are aggressively tracking the short mechanics of SNAL.
Stop right there. What exactly is a failure to deliver, and why do retail traders care about it so much in a gaming company?
It's a great question. Failure to deliver basically means someone sold a stock they didn't actually have, and when it came time to hand over the shares to the buyer at settlement, they couldn't.
They literally failed to deliver the share.
Exactly. It often happens with what's called naked shorting.
Okay, I've heard of that.
So when retail traders see a massive spike in FTDs on a microcap stock like SNAL, they smell blood in the water.
They see trapped short sellers.
Right. They view it as proof that the stock is heavily manipulated by short sellers who were trapped, which is exactly the psychological fuel needed to trigger a retail buying frenzy to force a short squeeze.
That perfectly explains the 854 million share volume.
It does.
It wasn't just fundamental investors looking at the SDE Inc. deal. It was retail traders trying to squeeze the shorts based on that FTD data.
Exactly. And compounding this toxic sentiment are persistent rumors about the company's past.
What rumors?
Well, the rumor is that past revenues from the wildly successful early days of ARK, and we're talking hundreds of millions of dollars here, were squandered on a completely unrelated, failed electric vehicle venture.
Wait, an electric vehicle venture? From a video game company.
That's the rumor. The community believes this alleged side project is what led to the parent company's current heavy debt load, which is now forcing the current aggressive monetization of the game.
But hold on, how does online drama actually affect SNAL's stock price for regular investors like me?
Wow.
I mean, if bookings are up over 20%, players are clearly still buying the games and the DLCs, even if they're complaining on message boards while they do it.
That's true.
You just said ASA crossed 4 million units. Does forum anger actually translate to the balance sheet?
It's a very fair pushback, and you're right. In the short term, clearly the complaints haven't stopped the cash register from ringing.
Right.
But this raises an important question about the long-term health of the business. In the gaming industry, brand trust is a tangible, monetizable asset. If player fatigue sets in because of perceived monetization abuses if the community decides the game is fundamentally pay to win, or that the developers are hostile to them, that 20% bookings growth can evaporate overnight.
Just disappear.
Exactly. And because SNAL relies so incredibly heavily on a single franchise, the ARK universe, for the vast majority of its revenue, that community sentiment becomes its single biggest vulnerability.
They don't have a backup plan.
Right. If the ARK community leaves in protest, there is currently no safety net for this company.
Wow. Okay, so SNAL has all its eggs in the ARK basket, and the basket is currently on fire on Reddit.
That's one way to put it.
Got it. So knowing the community is restless, the balance sheet is incredibly tight, and they're burning cash, what is the plan to survive?
They do have a plan.
Right. Let's examine management's plan to outrun their debt and keep players engaged over the next 2 years. CEO Shi recently laid out a very ambitious 2026 and 2027 roadmap.
He did.
First off, They've upgraded their internal development to Unreal Engine 5.7, and they've expanded from one internal studio to 4.
And we should note why Unreal Engine 5.7 matters.
Oh, absolutely.
It's a massive leap in graphical and processing fidelity. It allows developers to build massive open worlds with dynamic lighting and rendering without crushing system memory.
It looks gorgeous.
It does, but it is incredibly resource intensive. It requires highly paid, specialized development talent to utilize correctly.
Right. And here's the kicker. They're targeting massive $500 million revenue goals for 3 brand new AAA intellectual properties currently in final development.
Ambitious goals.
Very. We're talking about For the Stars, a massive space exploration game, and 2 games based on Chinese martial arts and cultivation mythology, Nine Sutra, Immortal, and Nine Sutra, Wushu.
Plus the ARK updates.
Yeah, add to that an aggressive 2026 and 2027 ASA roadmap that includes ARK World Creator, which brings user-generated content to consoles, and the Survival of the Fittest esports remake.
It's a lot of content.
Wait a second. I need to stop right here.
What's up?
You just said they have a current ratio of 0.6 and barely $8.6 million in unrestricted cash.
Yes.
How were they possibly funding the development of 3 massive AAA games across 4 studios? AAA games cost tens, sometimes hundreds of millions of dollars to make.
That is the million-dollar question, or perhaps the $50 million question.
Doesn't make any sense.
The math does not easily compute. They are likely banking heavily on the continued cash flow from the current ARK user base to fund this pipeline.
Which brings us right back to the gamer drama.
Exactly. It brings us right back to why the gamer anger is so dangerous. If bookings dip, the funding for these new games vanishes. There is massive execution risk here.
Because they don't have a buffer.
No buffer at all. And several of these game releases have already slipped from previous targets into 2027. Building a AAA game is notoriously difficult, expensive, and prone to delays.
So they are betting the entire farm on games that might not come out for another year or 2 with money they barely have.
Exactly. But more urgently, there is a ticking regulatory clock that represents the ultimate bear case for SNAL.
Oh, right. The Nasdaq issue.
Yes. They have received a Nasdaq deficiency notice.
Ouch.
They failed to meet the minimum bid price and net income standards required to stay listed on the exchange.
So what happens now?
They face a hard, non-negotiable deadline of May 11th, 2026 to submit a compliance plan.
Let me get this straight. It's like they're trying to patch a leaky ship by building an entirely new luxury deck.
That's a good way to look at it.
It looks great to the passengers, and the new game announcements sound amazing, but if they don't bail out the water by that May 11th Nasdaq deadline, the whole thing sinks anyway.
That is the perfect analogy. The new playbook doesn't matter if you aren't allowed on the field.
Right.
If they fail to provide a viable compliance plan by May 11th, they face delisting.
And what does delisting actually mean for the stock?
Delisting would relegate the stock to the over-the-counter markets.
The pink sheets.
Right. That would absolutely crush the stock's liquidity, force institutional investors to exit their positions, and make it virtually impossible for them to raise the cheap capital they desperately need to finish those Unreal Engine 5 games.
Man. So what does this all mean for the listener?
It's a lot to process.
Let's bring this deep dive to a close and kind of synthesize this wild dichotomy we are seeing with SNAL.
I'm sorry.
On one hand, you have a stock seeing 300% momentum spikes driven by retail traders jumping on FTD data with over 800 million shares of volume.
Which is undeniable momentum.
You have real, tangible monthly cost savings from renegotiated licensing deals, massive 20% growth in quarterly bookings, and a multi-year, multi-studio content pipeline built on cutting-edge game engines.
The bull case.
Right. But on the exact same hand, you are looking at a company burning through its limited cash, governed by questionable related party transactions, facing fierce backlash from the core gamer audience paying their bills, and literally racing against a Nasdaq delisting clock.
It is a profound contradiction, and I want to leave the listener with a final, broader concept to mull over.
Lay it on us.
It's the double-edged sword of the turnaround microcap.
Okay.
When a company's enterprise value is this astonishingly low, and the float is dominated by retail momentum, even a minor operational win like a single indie game going viral or a minor cost reduction can mathematically multiply the stock price overnight.
Like we just saw.
Right. The leverage to the upside is incredible, as we saw in April. But the blade cuts both ways.
How so?
When you have anemic cash buffers and severe debt, a single missed development deadline, a failed game launch, or a regulatory misstep can spell total disaster. The margin for error is effectively zero.
Zero margin for error. That is intense. All right, listeners, what's your take on the future of SNAL? Are you bullish on their Unreal Engine 5 expansion, strong bookings, and aggressive cost cuts?
Roar.
Or are you bearish on their cash burn, the insider debt structure, and the intense gamer backlash? Or maybe you were just sitting on the fence waiting to see what happens with that critical May 11th Nasdaq deadline.
It's definitely one to watch closely.
Let us know in the comments. We read every single one.
Yeah.
See you next time on the Bite-Size Brief.